Wow, what a huge day in financial markets. I don't even know where to start. I guess we'll start with CPI. That's where it all began. CPI came out this morning. Big shocker. Higher than expected. I don't know how this keeps happening. Every month the CPI comes out, and it's always more than the wizards of smart are expecting. They expected it to be 8.1%, annualized, of course, not 8.1% month over month. And actually, no, it wasn't month over month annualized. It was I need to be sure here. They were expecting 8.1% year over year. So from, I believe this is September, from last September to this September, they were expecting there to be an 8.1% rise in the CPI. In reality, it was 8.2%, which may not sound like a lot, but when you are hoping, as a Wall Street guy, for the Fed to stop hiking rates, and the CPI comes in higher than people were expecting, there is not a smaller chance, or there's not a greater chance that the Fed's going to quit hiking and start cutting. There's a smaller chance. In fact, there's a higher chance that they're going to keep hiking for longer and hike higher and start cutting rates later. And according to the chart I saw in Zero Hedge, and I think this is somewhat close to accurate for this time. Of course, these are fluid, exchange traded markets. Things change. I believe that the expected level for the Fed funds rate in March of 2023 now is all the way up to 4.9%. That's like back to 2005 levels of the Fed funds rate. That's back when that was enough to bring about the financial crisis way back in 2008. And we are way more built up. There's way more debt in the system now that was taken out at a much lower interest rate to begin with. I'm stuttering here almost because I can't put into words how disastrous of an impact this is going to have. And it's not like, I want the Fed to cut rates. I don't. This needs to happen. The collapse needs to come. But it's hard to believe that it will come and that they're going to let it come. But what did I say earlier in the week, or was it last week, when we got the unemployment numbers coming out? Unemployment was less than expected. People are, the labor market is stronger than expected, and inflation is higher than expected. Those are both signals to the Fed that they need to keep hiking rates, and that they need to hike rates perhaps more than they were planning on hiking them before. And even Jamie Dimon, CEO of JP Morgan Chase, the bank that just kicked out Kanye West because he is not woke, that bank, Jamie Dimon, came out and said that he thinks that the Fed is not going to stop at 4 and 4.5%, that they're going to keep hiking, that there has not been, we haven't even started to turn the corner yet. So why would the Fed quit hiking at 4 to 4.5%? If the Fed is not able to make a dent in inflation and the labor market with rates where they are now, which is at the 3 to 3.25% range, I checked today. The effective Fed funds rate is right at 3.08%, so on the low end of that range. And we've still got inflation over 8%. We've still got supposedly using the phony government numbers, we've got record low unemployment. And so when you look at that, it wouldn't be, under normal circumstances, if there were different people running the Fed, if there were just like an objective, robot running the Fed, it wouldn't be unreasonable to think that they could get as high as 6%. They could double from where they are now, and that's with mortgage rates already knocking on the door of 7%. I can't remember if it was Fannie Mae or Freddie Mac, but they put out their average for a 30-year mortgage in the country today. The average, according to them, 6.92%. So almost, not quite the average, but a good chunk of people now, nearly 50% of people who are applying for a mortgage are getting an interest rate of over 7%. Who's buying a 2-bedroom, 2-bath, $350,000 house at 7% interest with a 30-year mortgage? Nobody's doing that. And so real estate, thankfully, is finally going to crater, although real estate moves very slowly, so it'll be a while before anybody can take advantage of that. By the time that real estate does bottom out, interest rates will be back down probably. The Fed will, be well in, will probably, will cut back to zero a long time before real estate bottoms. So at that point, if you're able to qualify for a loan, if you have money saved up for a down payment, you'll be in good shape here in a few years. But again, that is a few years from now. That's not anytime soon. For right now, you've got 8.2% inflation to deal with. And you, quite likely, maybe among the people who get laid off from their jobs, because, frankly, that is what the Fed is counting on to kill inflation. They need to kill the demand side because supply side is not coming back. It's not coming back under this president. I do think that at this point things are so bad. They would be better under Trump. Most of the time I say, these presidents aren't different enough economically to really make that big of a difference. But Joe Biden's administration is so hostile to energy in general, to real energy, realistic sources of energy. And they are so, antagonistic towards the rest of the world that it is unquestionable to me that if we had a less bombastic administration like we did under Donald Trump, a more pro-energy administration, things would be much better than they are now. Because in order to kill this inflation without bringing back the supply side, the Fed is going to have to drive us into a depression greater than what was experienced after 2008. We are going to have to go back to a time more akin to the 1930s in order to bring inflation under control, because we are simply going to have to make it impossible for people to consume. The consumer is going to get creamed. That's the solution here. That's the Fed's goal. And yes, in the process, they're going to take out Wall Street. But make no mistake, they've been inflating Wall Street, creating lots of inflation on Wall Street. Going back to 2009, March of 2009 is when the market bottomed. And ever since then, it's been straight up. They did that without inflating consumer prices for the most part. I mean, they did a bit, but in relative terms, the amount of inflation that we saw on Wall Street versus Main Street was nowhere near 1-to-1. The inflation in financial assets was often 3, 4, or 5 times greater than CPI. So the Fed's goal is not to kill Wall Street. They're very happy to prop up Wall Street, but they understand at this point, I think, that inflation on Main Street has gotten so bad that they're going to have to stop propping up Wall Street in order to do something about it, which is what they're doing right now. And so, if things go according to plan, to what common sense would tell us needs to be done, Wall Street and Main Street will both get creamed together. But again, I will be skeptical of the Fed doing the right thing all the way till the end. And then finally, once it's all over, I'll be able to look back and say, okay, how far off was my cynicism? Because I understand it is cynicism. Just look at how much they're raising. If the Fed was really serious about trying to stop inflation, they would be hiking much more aggressively. But to me, it's just a surprise that they're hiking at all. So it's not that the Fed, that they're doing the right thing. It's that they're doing better than I would give them credit for, than I would expect them to do. But then again, maybe heat and pressure, it changes people. The Fed was doing exactly what I expected them to do for a long time when they were burying their heads in the sand and saying, la, 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 inflation is transitory. Well, eventually, when the inflation lasts multiple years, it becomes very difficult for them to call it transitory anymore. And so, they've evolved their position. So getting back to what we saw today, we saw a massive sell-off at the open, followed throughout the day by an even more massive rally. There was, like a 1,400 point swing in the Dow. I read somewhere, I didn't look exactly at the charts. I think I saw that the S&P bottomed this morning when I was looking, like at 35.86. Somewhere around there. It was in the 35s. Or no, it was lower than that. It was like at 3,500. And then I think it bottomed maybe 34.86. Maybe it was below 3,500 it bottomed. And it ended up closing like 36.69. So up almost 100 points on the day after starting out down. I saw it like 77 points down at one point. So like 175 point swing, somewhere around there, maybe 200, maybe it got lower than I'd seen. Which is needless to say not normal. It's not indicative of a healthy exchange traded market. It is the sort of thing that you see during periods of extreme decline. You see these massive sell-offs and you see even greater rallies. That's why they call it the slope of hope. Because when people see massive reversals like that, it does give them hope. But ultimately, what you need to watch is the Fed. The Fed has made this stock market what it is today. Think about how far above we are from where we were before the Wu flu, back in early 2020. It's not like the economy has exploded since then, and all the companies in the U.S. economy are worth so much more money because they're so much more profitable. That's not the case. P/E ratios have just exploded, and now they're collapsing back down to earth. Of course, we're nowhere near normal, what is considered to be a reasonable P/E ratio. So as the Fed hikes, things are going to get worse and worse. There's always rumors about a 100 basis point rate hike from the Fed. I wonder if we'll ever get that. It'd be interesting. But I don't think it's going to happen this time, at least not yet. The Fed goes with where market expectations typically are. The expectations are for a 75 basis point hike, another one. So that's what they're going to do. The range is going to be 3.75 to 4% after the next hike. And that, of course, would come, I believe, after the midterms, right? I forgot to look at the date when the next Fed meeting is, but I assume it would be after the midterms. But this was the last inflation report before the midterms. And it's not looking good. 8.2%. That, if I were a Republican, I'd be putting that in my ads. I don't think the Republicans are smart enough to really understand those things, because it's not like they would really want to do much themselves. The vanilla Republican Party is, I don't think, interested in doing what needs to be done to solve inflation. I don't know, I wish they would prove me wrong. But they seem very happy, to go all in on the green agenda too, as long as they do it, in an orderly fashion. We need to deindustrialize in an orderly fashion. That's all, But we agree on the end goal. It's just a matter of how we get there. You see, the Democrats, they just want to make everything so rough and quit cold turkey. The Republicans, they want to give you some Nicorette gum. So, with that said, I will see you folks back here tomorrow.